and hello to property and Propenomix people as well. So if you've watched before, you'll know I like to start with a quote, and this week's was, whilst we have halved our growth forecast for 2026 to 2%, it is important to look at the why. We're seeing a temporary drag from budget uncertainty and sticky inflation, but the underlying undersupply remains a driver of total returns for the next 5 years. For those who can look past the market lull, the market is effectively laying the groundwork for a 22% price surge by 2030. And that's from Lucian Cook, who is Savills Head of Residential Research. Now, I'm a tiny bit more bullish than Lucian, but it's good news to see that even in the broader public domain, one of the big forecasting houses at least is willing to pin their colours to the mast on the growth in UK residential property. And what I'm going to be talking about today primarily is what I'm calling the golden quarter to start us off in 2026. So that'll all be covered in the deep dive section later on in the video. And as the general public basically fall into another trap of doing whatever everybody else is doing and not thinking differently, this video, I hope, is going to help you to not fall into that trap and actually think differently from the crowd and hopefully benefit from it, apart from anything else. But as the calendar creeps towards a new year, it's a natural time for us to have a pause and tackle the biggest challenges that keep SME property businesses from achieving true sustainable growth. For most people, this boils down to two core areas. Number one, laying a bulletproof strategic plan for the next 12 months. And then finally, also cracking the code on financial measurement and accountability. If you've ever felt lost in a sea of bookkeeping data, or if your productivity methods are falling apart, it's time you switch from doing to leading your business and truly understanding how your assets are performing. So make sure to book in on the next property business workshop with myself and Rod Turner, Thursday the 22nd of January 2026 in central London, tinyurl.com/PBWNINE. There's also a link in the show notes. So first up, I'm going to just say a little bit about Project Continuous Improvement that I'm running on the supplement in general and these lives as a rule. Thank you for all the feedback that I've had so far. Please keep it coming. Right, let's get straight into Trumponomics. Now, it's difficult to look past the 4.3% annualized GDP growth. Most of the analysts took a fairly obvious political stance one way or another, unfortunately. But here's the reality. There have been some very disappointing figures in the first two quarters, in the first half of the first year of the administration. Tariffs generated uncertainty, anecdotal examples of Trump supporting businesses that got caught in the crossfire and have gone bankrupt, apart from anything else. But remember, I've said all along, these are goods-focused policies, right? Goods are important, but they're not as important as services. But this 4.3% was more than a 1% overperformance to the upside. Pretty rare in terms of economic consensus and seeing these sorts of things happen. And there is a macro reasoning behind this apart from anything else. And that is ultimately that GDP is defined, apart from anything else, at the tail end by net exports. So how much do you export and how much do you import? What happens with tariffs? Well, you import less, apart from anything else. And you may well export a little bit more, but you're certainly going to import less. So when you do the net exports calculation, X minus M, as the macroeconomists call it, that could easily add up to 1% or maybe a little bit more to the GDP. And this is the quarter where that really kicked in, aside from anything else. It just is what it is, basic macro, apart from anything else. But what also were the reports out the US? Well, robust consumer spending. The UK looks across the pond and dreams of robust consumer spending. We're too scared to spend our money at the moment due to us having no faith in the governmental administration, apart from anything else as a whole. Surging healthcare services. I mentioned the net exports already. Weaker dollar has also helped. Trump can't come out and say, oh yeah, we're going to make the dollar weaker because that's going to help us in the export and import market. But that's exactly what's happened, exactly what's been done. It's a strategy that's very much been followed. 15% or so shaved off the Dixie this year, the dollar index, as far as it compares to the basket of world currencies. Pretty good play, really. A lot of the countries that want to export a lot have run weak currency strategies against the US. For decades, the Japanese have run that strategy, apart from anything else. So not a bad idea at all. AI-driven IP investment, apart from anything else, but this time round, AI only contributed about 14% of this 4.3% quarter-on-year growth that we saw. So not as bad. We've seen claims this year that AI has been 100% of the meaningful growth and things like that. That hasn't been the case. Now, federal government spending also went up. There hasn't been a big deal made of that, but that's mostly defence consumption aside from anything else, which we know is going to be big under Donald Trump. But individual state and local government also spent big. And there's also a bit of a suggestion that consumers might continue to be front-running tariffs in the US because they're worried about bigger tariffs coming in the future, and therefore they're spending now. But the top 20% of households enjoyed higher stock prices, they got more wealth, and they spent aggressively. So, all in all, God bless America. Personal consumption contributed about 2.4% of the 4.3%. Net exports 1.6%, which is a massive contribution from net exports, as I've said, tariff-led. What about UK investment? Well, the US and Mr. T are still not happy about this digital services tax, which is 2%. If you don't know, effectively, it has to be implemented on the turnover of those tech businesses because they don't pay any corporation tax in the UK. They need to be careful with this argument because it isn't that they don't pay any tax in the UK, and that's sometimes how it gets framed. They pay plenty of things like PAYE and all the rest of it. But of course, these tech companies don't have many employees compared to their turnover. And the feeling is, and I think it's correct, that they suck more out of the economy than they put in ultimately. And therefore, a tax on turnover of sorts of digital services tax is the only way to go. How does Mr. Trump look at it? Well, he sees it as the UK. Another tariff is effectively how he sees it. Us taking more out of the US economy that could be kept, well, frankly, in Bermuda, apart from anything else, but back in the cash piles that he may well be able to tempt back onshore with the right sort of tax regime. And he just simply sees it as a patriotic thing, I think, apart from anything else. So there's a £31 billion worth of tech prosperity investment that's been promised from the US that's on pause at the moment that Mr. Trump is not playing with. I'm also not happy about the food safety regulations that they describe as too stringent in the UK. Chlorinated chicken gets mentioned again and again, hormone-fed beef and all the rest of it. I'm pretty hopeful that the UK government is not going to concede on that side of things. Will they concede on the digital services tax? Morally, they shouldn't, but it raises about £600 million a year. It's not all the money in the world, so if they need to make a commercial decision, so be it. I think they'll need to find another way to try and hit the tech businesses, possibly through business rates. Possibly business rates on tech businesses just need to be gigantic, and the multiplier needs to be completely and utterly different. I'd consider it one way or another, and perhaps I'd be quite cute with that. Concede on the digital services tax, find another way to tax them. They still need infrastructure in the UK ultimately. Perhaps hit it on the data centres of a certain size. I don't know, but we're going to have to find a way to capture at least some of the value. And 2% on turnover, frankly, for all of those businesses, apart from Amazon, and that's a difficulty because Amazon works to a lot lower margin, generally speaking, than all of the other big tech businesses. But as I say, we're talking about less than £1 billion. I regularly say, unfortunately, £1 billion is not a lot of money in today's economy. So it's no different for the digital services side of things. It's just completely unfair. But these companies are so large, bigger than some countries apart from anything else. What are we going to do about it? We're better with them than without them, probably. Although a bit of societal impact and a bit of pressure. And of course, the EU approach in a slightly different way. They just fine them on a regular basis, and they bring in more in fines than they bring in on taxation of those businesses, which is interesting. And it's not gone unnoticed in the US either, because the US are very, very anti the EU at the moment, primarily because they're the one organisation or set of nations big enough to actually threaten the US in any way, shape or form. But also, Mr. Trump, I think rightly, probably feels that they've been on the take from the US, especially when it comes to defence and things like that over the years. So we seem to be fairly determined not to give in on either of those, but 31 billion is a big investment on the tech side of things. And I think the digital services tax would be the one to go if one did go, is the summary of that side of things. So this, of course, pours extra cold water and scorn on the done deals that have already been done in the UK, including UK pharmaceuticals being spared from tariffs. Commentators basically suggesting that these promises from the US are built on sand, which it appears they are, while the big dog is in charge. If he needs to change stuff, he changes stuff. Ultimately, that's how he does it. Steel tariffs still in place at 25%, and the US wants stricter supply chain security. With reports this week about China's aggressive buying of precious metals, controlling the global price somewhat. You might have seen what's been going on with silver, with gold, with platinum and things like that. The US are in the background both envious and fearful of what the Chinese are doing in that department. So the irony of the home of free speech restricting speech with selective visa bans probably shouldn't be lost on anyone either. The other side of the fence, if you're saying any bad stuff about America, you're not allowed in. I'm stunned that some people are not accepting there has been an element of restriction of freedom, and these are democratic steps backwards, not forwards. But that's where we are. It all gets too political too quickly. To me, that seems objectively proven at this point in time. Trump likes it autocratic. He wants more European autocratic leaders. We tend to focus in the press on things like, well, actually, he wants more right-wingers and he wants more this and he wants more that. He wants less democracy, is what he wants. And I think you'd be better off focusing on that side of things. And he also wants his frenemy, aka the EU, as already discussed, to be weaker than him. And the way to do that is to cause disruption within the EU, a policy that, in fact, all foreign policy has covered over the years often gets blamed on the Russians and the Chinese, like we haven't had and haven't got espionage going on around the world that's been disrupting regimes ever since we've had diplomats, apart from anything else. So there we go. But anyway, that's the US for the wrap up for the year. What about the UK real-time property market? Well, Chris Watkin had delivered his last property market stats bundle of the year the week before Christmas. He had an extremely handsome guest on week 49's show. If you haven't seen it, yes, it was me. And yes, I did do that gag last week, but I'll be pressing on with that. We don't have any new stats. We don't have any week 50, 51 or 52 for this year, but I'm just going to forecast where I think we're going to end up, having watched these stats every week this year and having a pretty good handle on it. And of course, things quietened down very much over Christmas as well. So final listings north of 1.7 million. We saw more stock hit the market than any other apart from 2024, probably, but very, very close to 2024's listings. About 100,000 more properties listed than an average pre-pandemic year. The average month of 2025 saw 100,000 properties reduced in price on the portals, on average, 12.8% versus 10.74% over the 5-year average. I'm a little wary of the 5-year average because it probably gives a bit too much bias to what happened during the lockdown, what happened in that very expansive period of the stamp duty holiday after the main lockdowns were over. A little bit cautious, but 12.8% reduced. It was heading for about 14% at one stage, so the reductions came right back down in November and December. But that's often the case as the cycle plays out in a year. Sales agreed over 1.25 million, best year since 2021. 2021 was so good for sales agreed, it was over 1.4 million. So a really insane year. But if you remember that market, wow, oh wow, it was hotter than the sun. So it was a big one. Not an easy market to buy in, a very, very good market for selling in. Average fall throughs per month, about 26,400. I still find it unbelievable that many properties fall through, that many transactions fall through in the UK. So about 300,000 plus fallen through over the course of a year. But unfortunately, rightly or wrongly, that is around the long-term average of numbers of deals that fall through. Net sales, therefore, are going to settle between about 950,000 and 1 million. Once again, second only to 2021. Really quite close to the 2020 figure, which was a very strange market, if you remember, restricted and closed for much of it, apart from anything else. Also powered by a stamp duty holiday, whereas this year we've had stamp duty go up, not downwards, on the 1st of April. 8.4% ahead of the pre-pandemic average, though, which is a pretty good yardstick if any of you remember when things were normal, per se, as we call it. We'll likely hit the 1st of January with about 600,000 properties on the market. There have been reports of broken records with the number of Boxing Day listings, apart from anything else, but I suspect you'll also get confirmation of a record number of withdrawals. And that looks very much like the start of 2025, and it will be a higher stock level to start the year than it has been for the past decade. But where will we finish the year on prices, sold subject to contract prices per square foot? Like to look at this because, as Chris identifies, there's a correlation in the high 90s between the sold subject to contract price and the land reg price that washes out about 5 months hence. Because, of course, sold subject to contract versus actually transacted and completed takes around about that 5-month mark. Unbelievable though it is, that's the UK system for you, apart from anything else. So we're probably looking at about £344 a foot for the finish of 2025, apart from anything else. A pretty limp year for capital growth. We're pretty confident we're going to end up between about 1.5% and 2% up on the year when the ONS figures come out. I only really rate the ONS figures. They are the actual figures rather than people's proprietary indices like the Nationwide and the Halifax, it's the right context. You'll get them about mid-February, apart from anything else. But what is that 1.5 to 2%? Well, lower than wage growth, even after tax, apart from anything else. Lower than inflation. Good context. So property, once again, has got relatively cheaper over the course of 2025. But of course, that stamp duty recalibration, whatever you want to call it, made it more difficult to buy. Now, Chris always gets a weekly shout out from me because he comes up with such great stats on a weekly basis, week in, week out. It's not the only thing that he does, this massive tome that he releases every week in the stats show. He gets an extra glow up, of course, because he's recently had me on the show, apart from anything else. But please do drop him a like, a subscribe, a comment, and the rest of it for his content creation. And if you're in the property industry and you're interested in any ghostwriting or how to become more of a local expert and evidence that in your local area via your marketing, via your social media, that's what Chris does day in, day out, week in, week out. Give him a shout. Make sure you give him a follow. Got a brilliant YouTube channel at Christopher Watkin. So the macroscope tends to gather dust around Christmas week, but we've had some revised GDP figures to see out the year, which we're going to take a look at. And then we can't miss out Scottish house building and second or empty home data, because the Scottish data is quite tight and it's quite good to look at. And I think it gives you a rough idea of what's going on in the rest of the UK as well, although there are some differences, of course. And of course, we've had such a busy month, we haven't yet put in the ONS house prices and rents report for December. So it may be a light week, but we've also still got to discuss the gilts and the swaps. So that brings up the rear, as it always does in the macro section. So revised growth, well, no coverage at all that I saw of excellent business investment figures that came out. Economic consensus was minus 0.3% for Q3, but actually we saw an increase of 1.5% quarter on quarter. Businesses seem to be moaning loudly, but pressing on with investment. Perhaps they do read the supplement after all and are just keeping calm and carrying on. Growth was clipped back by 0.1% after a revision downwards, although there was a revision upwards in 2024, so that was sort of biased reporting again, really. People only reported the 0.1 clip in Q2. They didn't talk about the 0.1 clip upwards in Q4 of 2024. But the Q3 year-on-year figure still remains at 1.3%, still better than I thought it was going to be. But you know what, the end of year figure might not be too far away from that 1% I had at the top of my range after I heard what was going on in the 2024 budget. And I did a big revised forecast downwards. So the normal growth revision reports are not really up to much, but this one brings a few patterns of news which at first glance seem incongruent and definitely demand some closer attention. 2024's GDP was unrevised at 1.1%, so lower than we would like, but is that terrible given we had an election year with an almost certain change of administration, which obviously is what happened, bringing big political disruption and probably more uncertainty than there'd been politically for nearly 15 years. Although you might argue when Jeremy Corbyn was in the shaker, that was also pretty uncertain, but the polling was very, very much in Boris's favour, of course, when that happened, or when he was against Theresa May, of course. So, real GDP per head or per capita, to give it its proper posh name, up 0.9% quarter on year, a better figure than we've seen for some time. And people often say GDP's rubbish, it's no good, we have so much migration, it doesn't count, blah, blah, blah. GDP per capita is a much better measure. It's better than GDP, but GDP's still not right. And we'll get into what's going on there. So 0.9% up year on year, although it doesn't sound like very much, is a really good result actually for the UK over recent years. And it is a better metric than real GDP alone, but what I much prefer and how the people are really feeling is much better encapsulated by RHDI, which is the real household disposable income. Real, modified for inflation. Household, so not just individuals, but households as they're made up currently in the UK. Disposable, after HMRC have had their bit, and that's a very relevant part at the moment, as I'm sure everyone watching this will be feeling. And then income, ultimately. What have people got to spend? They either spend it or they save it, apart from anything else. So, how was RHDI? Disastrous in Q3 2025 is the answer. Down by 0.8%. That's quite significant. So this year we've had a minus 0.9 in Q1, a flat Q2, and a minus 0.8 in Q3. So no wonder if people aren't happy and don't feel good. That's 1.7% without the compounding in the first 3 quarters of 2025. Not a successful year at all, right? Really needs looking at, apart from anything else, a complete disaster. And I'm not sure, again, if the Labour Party even understand this. But there we go. Savings ratio still far too high, in my opinion, at 9.5%, but that's come down from a high of 12% within the last 12 months. Why do people save more? Because they're worried about the future. There are other reasons, of course, such as they've got a much better interest rate than they had, say, 5 years ago, and they have, but it's not the point, right? So confidence would bring down this 9.5% to 8%, 7%, 6%, and 6s and 5s are perfectly safe apart from anything else, right? But can this political administration really inspire confidence in the consumer as a whole? So hang on a second. I know you're going to be rightly thinking this at this point. How is GDP after inflation able to be this low apart from anything else? GDP per cap is up so much. Why are we doing so badly? So RHDI, well, it's all the D, as I've said, disposable income. Tax has clearly hit that hard. That we're so badly broken after the last 6 months, the last 9 months, apart from anything else, that's what we're suffering with. Just bear with me a second. Thank you. So what are we going to do about it? Well, we're seeing wages still outstrip inflation by a bit. It's not the wage problem, aside from anything else necessarily, but we're not having a great time of it, let's face it. So public sector employees are doing well, but others are not. So it's easier for me to be more brazenly political than the ONS are about this. So how did they pussyfoot around that issue? Well, it's all rather perverse, really. GDP per head in 2024 was up 0.0%, but RHDI was up 3.3% because there were tax cuts, of course, apart from anything else. So Jeremy Hunt, remember, put national insurance down aside from anything else. Q3 and Q4 saw a lot of that with real progress on the RHDI number. 2025 looks more like a horror movie, really, because of this 1.7 down. I'm not surprised that Labour have stopped saying growth, 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 because it's simply not happening apart from anything else. We've got growth, not lots, not enough, but some, and better than per capita growth for some time. But the only thing growing is tax and government spending, not RHDI. So if people aren't feeling better off, well, frankly, that's why. It's very obvious, right? If you're better off, well done. You've done well, as anybody else. So your auntie might not be feeling better off. Your uncle might not be feeling better off. Your sons, your children, your daughters, your parents might not be feeling better off. So one other way to address this, of course, well, because it's been directly impacted by higher inflation in 2025, if you can't achieve growth, then ultimately control inflation, and then you get, then you're going to get it. You're going to get RHDI up because you're going to get the inflation number down, and that's what we've seen very recently, and that's what suffered from probably in Q3, apart from anything else. Where did this inflation come from in the first place? It was Rachel Reeves' fault in the first place. It went up simply because, apart from anything else, there was so much more going on in the budget after the employers' national insurance rises, aside from anything else, right? So, get inflation down, control RHDI. Yeah, let's hope so. Anyway, we've had good inflation news recently, although it's so good, it set the hairs running at Propenomix HQ to try and explain it, rather than just accept it was a big downside miss. The Bank of England are now suggesting inflation will be down to 2% as quickly as Q2 2026. So within a few months, we're going to see 2% inflation, according to the bank. And then near-term forecasting, outside of a crisis or an unusual set of circumstances, is normally pretty good. Why? Well, it's because people are hoarding cash in expectation of losing their jobs or as having a recession, which is not good because it can become a self-fulfilling prophecy. But with inflation down from the recent 3.8% prints back in September to 2% by June, if we really get there, I'm not so sure about we are going to, but like I said, Bank of England are normally pretty good on that front. Rents are much more stable, prices are behaving much more normally. Perhaps we will finally get there. I personally don't think we'll stay there, even if we do get there. And I need to see a quarter's worth of real progress on core inflation, right? Because core has been the problem. We haven't been below 3.2% core CPI for years and years, right? And that will stop me, perhaps, crying wolf, aside from anything else. So hopefully that helps to explain the economics and relate it to the politics and to your own pocket and the pockets of your nearest and dearest. Okay, I said we'd go off to Scotland. So the year to the end of September 2025, 18,347 new homes completed. 14,846 started. Completions down 8% from the year before. Starts down 5%. Private sector did the heavy lifting, of course. 14,225 completions, 11,815 starts of all of those, but still down 5% and 3.2% respectively. In the social sector, built completed 4,122, started 3,031. Completions down 15%, starts down 10%. Basically, bloodbath style figures, apart from anything else. Private sector, lowest since September 17 to 18. Starts, lowest since September 12 to 13. Yikes. But that's not even that bad compared to what happened in the social sector, with completions lowest since 16, 17, but the starts, the lowest they've ever been since Scotland started collecting the data in 1997. So triple yikes there. What about affordable housing supply programme? Well, even worse. Approvals down 22%, starts down 13%, completions down 23%. Affordable housing supply approvals are down 55% compared to 2019. We're basically rowing back a decade or more, or in fact, we have already rowed back a decade or more. So it's a mess. But one thing that Scotland have got right, however, is the balance between social and affordable rent, and 10% of their target is for rural and island communities, which is more of a significant factor in Scotland, given the population density, of course. The target by 2032 is 110,000 affordable homes. By September 2025, 31,064 have been completed, of which 24,112 are for social rent. That's 78% of the affordable completions for social rent, which is amazing compared to how England perform on that front. But the overall building figures are pretty woeful, and that's the trade-off. It costs a lot more to build social because there's basically no return on it apart from anything else. So do you choose fewer but social, which really helps people who are lucky enough to get a social home, even though waiting lists are huge apart from anything else? But is this the bottom of these terrible figures, or are we going to see another year of decay by the time we get to next December? I guess we'll find out. What about second homes and empty properties? 20,927 second homes and 44,453 liable for council tax that are more than 6 months empty. A further 44,989 with unoccupied exemptions. What's the context? Second homes down 3% year on year, empty homes liable for council tax up 2%, long-term empties up 2%, and 6% fewer properties with unoccupied exemptions. So not as crazy, but the directions of travel still look pretty clear. Better data than England? Well, that's not much we can say for sure, but in seriousness, other than some policy differences, you can see where and why the writing is on the wall for the house builders, whether they be for-profit house builders or not in Scotland. Okay, ONS private rent and house price report for December next up. Rent's only up 4.4% year on year, but that metric keeps sinking like a stone, down from 5% in November and from 9% in December 2024. In England, that breaks back to plus 2.8% in London. Remember, this includes existing tenancies, and this is why this data always looks so different to Rightmove data, Zoopla data, and other reports which rely on asking rents rather than a big sample of all rents. The biggest winners or losers, depending on which side of the bargain you find yourself, is the North East at 8.4% increase in rents year on year. October's prices, now remember this report lags by 1 month for the rents. You get November's rents, but then you get October's prices aside from anything else. The ONS figure plus 1.7% year on year, which was about our expectation over the last 6 months, thanks to Chris Watkins' excellent real-time data that he shares every week. Average UK house price 270k. In England, that's 292k, which is up 1.4 on the year. Scotland has dragged these averages up because it's performed at plus 3.3% year on year on house prices. Now, Wales averages 211k in average house price, which I would term to be the proximity to the wealthier England effect, because Scotland only averages 192k. This is in spite of the fact that Scottish households' income and Scottish wealth in general are well in front of Wales figures. Welsh rent is up 6.7%. You'd have to blame primarily policy failure there compared to England and Scotland. Scotland's relaxation of their rent controls has seen rent rises calm right down to plus 3.3% year on year. The peak was 11.7% annually in Scotland in August 2023 when they had rent control in place. Go figure, there's a lesson there, folks. If anybody making policy or writing papers about that is listening, what do you learn from that? Rent controls don't work. Well done. We've learned that lesson 100 times in the real world. Now, the inverted pyramid still look the same as they have done all year. Rent rise is lowest in London as affordability really is truly as close to its ceiling as it can possibly be for households, who, bear in mind, are nearly 2% worse off in real terms than they were in January, according to the RHDI figures. Highest in the northeast, who in percentage terms have benefited much more from having more employment that's pegged close to the minimum wage, which, don't forget, as recently as April 2025 was increased by 6.7%. And many employees there are not caught in higher rate taxes, of course. House price inflation, to round off, looks even more stark. The northeast is still leading the way at 5% compared to rents up 8.4%. So yields are actually still expanding up there, but London is now aggressively backwards in terms of property prices that have actually transacted in London in the past 12 months, dropping 2.4%. Now, London was down 1.6 on the September to September pricing, so it's still another significant drop over the last month or so. Suggests that the value drop is actually much starker than this in true terms, but transaction numbers normally just slow right down, and to perform that analysis properly, we need their regional transaction numbers, which I don't have. The Southwest has also gone backwards in nominal terms, so down 1.3% in 12 months. But remember, that leapt forward so very aggressively in the near wake of COVID, because working from home looked like a permanent solution, and those over-enthusiastic gains down in the Southwest market are now being realised away. So a 7.5% gap between the best performing region and the worst. The Southeast is the third region underperforming the averages. 0.7% gain though in the past 12 months, not downwards but upwards. This bifurcated market though has never looked quite so stark this so far in the cycle. When will that start to narrow again, rather than the gap keep expanding between the winners and the losers? The cheaper regions ultimately are chugging on at 2 to 3% growth, with the northeast being an outlier and doing much better than that, and I think there's no reason why they won't continue at that sort of pace next year. Okay, time for our last guilty pleasure of the year at the time of seasonal chocolate and cheese overload. For the 5-year, we opened the short week at 3.988% yield and closed on Christmas Eve at lunchtime at 3.974. With no news to move on, the trend this week normally speaks to the prevailing trend at this time. And this trend is mostly sideways with some volatility, because there's just not much volume in a week like this. And I have mentioned there's been relative stability in that 5-year gilt and the resulting 5-year swap over the course of nearly the last 2 years now, apart from anything else, which apart from anything else means mortgage rates on 5-year haven't moved very much at all. What about the 30s? Well, the 30s calmed a little bit. They opened the week at 5.267% yield and closed at 5.228. So we clipped off 4 points at the steep gradient of the longer term yield curve. But this year has seen consolidation of this steep yield curve, which actually started to look like this near the end of 2024. The difference in the yields really has all been at the short end. Curve looks a lot more normal, and the short end has come right back downwards. But if we pick on the 5-year, which is our bond of choice, the gap is 50 basis points cheaper on the gilt compared to 1 year ago. The swap yield has been clipped 35 basis points, so the other 15 basis points have been absorbed into the cutting cycle, if you like, because now we know one thing apart from anything else: we're closer to the end of this cutting cycle than we were 12 months ago, apart from anything else. So the swap yields on the 5-year are 3.643% compared to 3.634 1 month ago, basically identical, and 4.031 a whole year back. But as I've said, very limited movement in the mortgage market of note. We've clipped at some points over the year, 0.3, 0.4, but there were 5.25% products available not that long ago, maybe 12, 18 months ago, and there are 5.25% products available now in limited company buy to let. So there's been volatility, but there hasn't been a lot of move apart from anything else. So that's where we are. It's been about 22 months now. We haven't seen a lot of movement. The difference between high fives, though, when we have seen, because we have seen quite a lot of high fives at the point, 5.9, I remember being the lowest at one point over the last 12 months, and low fives is actually massively significant when you think about it, because so much of the UK's buy to let yields low to mid sixes, depending on which sources you listen to. So there's a huge difference between 5.25 and 5.95 actually as it goes. One of them will actually stack up on a 75% loan to value buy to let, an average buy to let if you like, and one does not. And the yields tend to cluster around that average significantly in a normal style distribution, the bell curve, if you're familiar with it. So Close off that little roundup of the year on the gilts and swaps. The 2-year swap is down 75 basis points. That's a much more significant and tangible difference. However, people using 2-year products, hoping for a more meaningful capital growth over that 2-year period, have been disappointed over the last 2 years, and indeed might put themselves in, apart from anything else, a little trouble in London. The strategic decision making that makes me stick to 5-year loans, unless there's a significant idiosyncratic reason for one specific property to be on a 2-year loan, has once again been vindicated, and I will be carrying that forward into 2026. So what have we got left for the last deep dive of 2025 then? Well, I caused a bit of a stir over the last week on my social media by discussing some terrible subjects, such as the fact that Co-op Insurance, that notorious subversive organisation, released a survey showing that 11% of current tenants, have received a Section 21 during their current tenancy, which caused a huge swathe of feelings around those who commented, including the concept from some experienced landlords that there'll be plenty more of those Section 21s coming after Christmas. Then there was me daring to share that I admire and believe that Denise Coates, the Bet365 chief exec and shareholder, should be praised for her tax patriotism, another new phrase. Who would have thought it would bring such a range of opinions? However, I'm going to be sticking to property, of course, and I'm going to weave in the concept that my newfangled gold-plated research team, aka Gemini's Deep Research, thanks very much Google for that one, an incredible game changer for me, has come up with. The concept of a golden quarter to kick us off in 2026. What does that mean then? And what is this concept? Well, the golden quarter might, apart from anything else, be more like a golden third, but we don't really talk about 4-month blocks very much. We talk about 3-month blocks, apart from anything else. But what is defining this third? Well, this 4-month block, the 1st of May 2026, the true implementation of the Renters' Rights Bill. So what's going to happen during this golden quarter? Amateurs selling as quickly as they can around us. These are the amateurs who know about the Renters' Rights Bill, of course. Then if we put them in another bucket, the amateurs who don't know about the Renters' Rights Bill, then they won't be, or the Renters' Rights Act as it is now, sorry. They will ultimately find out afterwards. I'm sure the headlines are going to take an absolutely terrible turn when some of these very big fines start being announced. Some of the local authorities, probably in London, but perhaps somewhere else in the country, will use their newfangled powers to raise a load of revenue, apart from anything else. We'll obviously see what happens, but when the people who don't know about the Renters' Rights Act then find out about it, I suspect their solution will also be to sell. Now, what's going to happen? Well, the other way of us splitting the market at the moment, apart from anything else, is amateurs and professionals, of course. There will be some people who consider themselves amateurs reading or listening here today, but you're unlikely to be listening to this if you've got an amateur mindset. You probably much more have a professional mindset. It just hasn't necessarily played out yet in terms of how big you would like your portfolio to get. So instead of that distinction, I think we'll just split into how many properties does a landlord own. The English Private Landlord Survey is likely the best source, although this is obviously confined to England, not the whole of the UK. But they put people in 3 buckets. 1, property landlords, with a high likelihood of being accidental landlords, I would argue. 2 to 4 property landlords, had a bit of a go, stopped there, perhaps decided to pay down debt instead of expanding, or maybe they just moved a few times in their life and they were lucky enough to hold on to the property they moved away from. And then the 5+ landlords. Now, the FCA and PRA definitions look at 4+ as a portfolio, but wherever you look, you're going to get different answers. So we'll stick with the English Private Landlord Survey. And what does it tell us? Well, 83% of landlords own between 1 and 4 properties. 45% of landlords own 1. However, they control 51% of the rental market. 1 property landlords only control 21%. But I'm going to concentrate on these landlords on the duration of this analysis. It's still half of the rental stock in England, which is about 2.35 million units at the last count. So, how about we split them in another way? Those who are tuned in and those who are tuned out. Some will self-manage, some will be letting to friends and family and things like that. I'd wager a lot of them are not compliant with every single one of the 300+ regulations that there are in the legal marketplace these days, even on pure technicalities apart from anything else. The tuned in are probably members of an organisation like the National Residential Landlords Association, the NRLA, or they subscribe to one of the myriad services or websites out there that provide relevant information to them in newsletter form, either paid or free, on a regular basis. The tuned out probably just use an agent to do their job. They're too busy. They're busy earning the money that enabled them to buy that rental property in the first place, etc., etc. Or they just haven't got the memo about just how much regulation and compliance has changed over the past 10 years. So, how about an example? Let's use a theoretical and call her Rachel. Rachel's married and she's in her late 40s. She's got a very high pressure job, which arguably the pay isn't really reflective of the level of her responsibility. Her job security is actually extremely tenuous, and her job sees her needing to spend a lot of time in Westminster. Have you guessed who it is yet? Well, she gets paid about 150 grand for the job. Some, based on recent performances, would suggest that's far too much, but many of us in the real world know that there's no way we would do that job for 150k if we were doing it for the money. Neither is she. She believes, or she did at one point, that she was the best person for the job. Still, the job does come with a rather swanky London address, one of the very, very greatest, and access to one of the most exclusive country clubs of them all. Admittedly only at silver level, although silver is worth an awful lot these days, but that's another story. And that's Dorneywood. Her hubby gets paid a bit more, even though he has the privilege of staying out of the spotlight. He's a senior civil servant, so their household income is around 300k or a little better than that, just on PAYE. But both are getting whacked as hard as you possibly could imagine on PAYE, as any employee at that level does. She gets a rather generous allowance for her expenses as well, although in recent years these have been scrutinised a lot more closely, and she can't even go to a Taylor Swift concert on a freebie these days without attracting unwanted attention. Rachel and her hub are in the top 2.8% of income taxpayers in the UK. Now, where they've found themselves for the moment is they've got a house they don't really need to use. So why not show a bit of that entrepreneurial spirit that seems quite so alien to some of her policies and rent the pad out, at least to cover the mortgage, right? Although that Section 24 tax bill will be something to behold when she submits that return in January. I hope she gets that one right for her sake. Now, Rachel's a busy lady. One of the very busiest, I think it's fair to argue. Kids as well, serious juggling act. Just letting out that property that I have no doubt she worked very hard to purchase in the first place, although current form does dictate that she might have massaged her CV here and there to get the position she's found herself in now. I know, get an agent and they'll handle it all, right? Should we go for a gold-plated one or just a cheap one? Because since we're all busy and it's quite hard to do all this stuff, isn't it, really? Oh well, Rachel, remember the selective licence? And you know about the regulation changes, don't you? If you were to lose your job, it's a funny job really, almost in two parts, with an enhancement for having that extra responsibility. It's only a 5-year contract with potential early release clauses, or more accurately landmines, which make the remuneration even more weak for the size and responsibility of the position. Well, you'd want that house back then, wouldn't you? Well, that's not going to be as easy as you thought when you let it out. I bet Diamond's Rachel didn't understand all of this, and indeed her actions have shown that she didn't. Now, Rachel is smart. I know some people are going to disagree, but she is. She's evidenced that over the years. She got into the toughest course in the best university in the world. I'm totally objective about that. Nothing to do with the fact that I did the same course in the same year as it goes at the same university as Rachel. And whilst there's a few that talk their way in, well, after all, they did let me in, didn't they? That's evidence enough. There's an issue here in recent years that's been raised by the presence of one Mary Elizabeth Truss, who did the same course, but we'll gloss over that for the purpose of this not very hypothetical example. Rachel's current contract will come to an end with a likely 6 to 8 weeks notice. It's guaranteed that she won't get a renewal. It isn't guaranteed, that she won't get a renewal, although she isn't very popular at work at the moment, and that's the understatement of 2025. And when Rachel wants her house back, if she does need it back within the next few years, she'll be using ground 1 of the Housing Act, occupation by landlord or family. The tenant will need 4 months' notice, which could easily be 12 months if the tenant doesn't play ball. The notice can't be served within 12 months of the start of a tenancy. So if Rachel's near the end of her contract, letting the property wouldn't be an option if she reads the rules closely, which obviously she hasn't been doing so far. If Rachel did then get a surprise job abroad or on the international speaking circuit, look, I'm just exploring possibilities here, I'm not making predictions, then she wouldn't be able to let the property for another 12 months, although presumably Hub and the kids would still need a place to live, of course. Now, as mentioned, Rachel did need a selective licence and she didn't apply to one, for one. Naughty Rachel. We haven't heard of any significant penalties levied on Rachel, and perhaps we can agree, because it is still Christmas after all, that that's fair enough. Although I thought ignorance of the law was no excuse. Oh well, never mind. Let's leave it. She's having quite a hard time anyway, although I guess that's what you sign up for. However, I think we can conclude Rachel is an amateur and a one-property landlord. That's to our knowledge anyway. It would take quite a lot for Rachel to sell up, with both income earners significantly entrenched in the higher echelons of the public sector. And of course, Rachel might retain her job at the next opportunity. Current predictions suggest she'd be odds on to lose that job, But Rachel needs to keep that house. She's just trying to nick a few extra quid and believes it's better tenanted than empty, I'm sure. And I'd agree with her on every level of that. So she's not selling, but I do hope she's perhaps keeping some reserves in case one of the convoluted arrangements actually plays out. So she doesn't really pay a lot of attention to it, but she really should be. It's worth a shade under £40,000 in household income every year. Not small compared to the circa 325k they already bring in as a household, about an eighth extra on top. It seems also that Hubster Nick has a 2-bed flat in central London that he lets out for another 3 bags a month. So actually rental income in the Reeves household is closer to £75,000 a year. So they're really one property landlords who are temporarily 2 property landlords. They won't change much thanks to the Renters' Rights Act, but they're a bit hamstrung. Now their situation is obviously idiosyncratic, but it tells a tale of successful earners in the top 3% of income earners in the population who've accumulated a bit of property somewhat throughout need and somewhat through accidental means. So, what would also be interesting is to ask Rachel and Nick if they do it the same way again if they were maybe 15 or 20 years younger and on a positive career path. Rachel actually said herself in an article this week that if she was 20 odd years younger, she wouldn't be able to buy the house that she's been able to buy so far. I'm not sure she's putting everything into context when she says that. I'm also not sure it's very helpful for the Chancellor to say that, but there we go. Then there would have been different stamp duty incentives for having that second property. There might have been an extra 50 grand or so in additional stamp that need to be paid compared to when Rachel and Nick bought their existing property. I don't know because I don't know the exact timelines, but there's a very good chance that that's the case. Now, Rachel's mate Angela, and Rachel doesn't really believe that Angela is her mate, and Angela thinks that Rachel's a bit of a wolf in sheep's clothing politically, but let's leave the personal side out of it. She told her that paying the extra stamp is optional anyway, so it doesn't matter, although it's very easy to get caught out, and perhaps that unity brought them a little closer together. But it is important to stay in with Angela because in spite of hypocrisy and indiscretions, Angela is made of titanium laminated with Teflon and is predicted to be Rachel's boss one day, although Rachel would be gone far quicker than in 60 seconds, most of us would predict, if that was to play out. So it's not easy then, even for some of the on paper smartest people in the country. Tough, I dare say. The hostile environment, as repurposed this year at Propenomix HQ for landlords who are playing at it, but controlling half of the private rented stock in England, 2.35 million units, I say again, is obviously very, very significant. So that's enough of my little Christmas tale. Anyway, I hope you enjoyed it. When did you start to realise who I was talking about? Drop me a comment below and let me know. But all of those 2.35 million stories will have a bit of a story behind them. A few 100,000 probably are under control of people who want to build a bigger portfolio and they're earlier on in their journey. Perhaps that even describes you, apart from anything else. But the majority are going to be some strange sort of tenure, a little bit like Rachel and Nick's story, but obviously that's individual. But what do these houses represent? Well, they represent capital that could be repurposed and released. That's what they represent to the asset owner, ultimately. Rachel might like it if that happened across the board, because apart from anything else, there'd be significant capital gains tax receipts for HMRC and for UK PLC. And that might help her out of a couple of black holes she's found herself remarkably near over the last 19 months or so of this very, very tough gig that she's taken on. Now, what we can't say with any certainty is exactly what situation some of these smaller landlords are in. Nick could sell his flat, for example, suck up the tax, pay the CGT, depending on how long he's owned it and what the lease looks like and all the service charges and yada, yada, yada. He could opt out of the rental market on that front and whack the proceeds in an ISA. I mean, it can't be all cash like it could have been because Rachel has changed the rules on that, but that's okay. I'll stop with all of that now. So there's not always that much flexibility for landlords like this. Some of them own rentals, as many rentals as they have children, because their idea has been to hedge just how hard it might be for their own children to get on the property ladder and therefore include 2 rentals, 1 for each when they're the right age, as the best solution. Those sound and feel pretty sticky in the rental market, don't they? Until the children are of age, of course. So it's really hard for me to make a meaningful estimate of exactly how many of these properties are easy to sell, flexible to sell, and would have willing enough sellers to pay the tax and the likes. Anecdotally, however, my post on the 11% co-op insurance section 21 survey, there are an awful lot of people coming out the woodwork into the safety of a forum on which they felt they could share their story. More than 3 dozen commenters reported they were selling up, not all because of the Renters' Rights Act. Some were sick of the idea of making tax digital. Some were scarred from Section 24, which has really kicked in over the last few years as the interest rates have moved up apart from anything else. Some were just not bullish on property anymore, had the other issues. They had flats, they had cladding, you know the drill behind all of this stuff. There's a ton of reasons to get out at the moment, and all of these lead to our golden quarter. Then some of that much denied landlord humanity came to the surface as well. A small number from the professional camp confirmed what I expected to be true. The first job in the new year for them is an issuance of a whole number of Section 21s to tenants that simply cannot be trusted in a rental property where possession of that property becomes more secure for the tenant. Better the devil you know, of course, but when you feel you have a potential devil, the golden quarter is offering the chance to get rid. So what will happen to some of these properties? Well, triage just as Henry VIII did with his wives, but instead of divorced, beheaded, died, it will be sold, tenant type changed, re-let. Now, this isn't happening till after Christmas because some of these landlords do have a heart. Just let Shelter know that the next time you speak to them, if you could. But don't be confused. You know, some of these have got dozens and even hundreds of properties that I speak to on a weekly basis. This camp was surprised that only 11% of current tenants had had a Section 21 so far, and they predicted this number's going to go up significantly before the 1st of May 2026. So what's the second level implication of this? Well, a massive crank upwards in terms of referencing. Rental stock is going down in number, but not at a breakneck speed. I think we've established that. Inner London has 7% less stock than it did last year, but that's an outlier. Most places have got more stock available than they had in 2024. We're not seeing this huge exodus. Most, and someone actually very kindly, a large agent in the East Midlands area, shared with me his figures and said, of the sales that have been made in his agency from his landlords, 84% of them have been bought by other landlords. And he's facilitated some of those sales. Now he's got a book in the 1,000+ region in terms of the number of properties that he manages. So I'd say that's a pretty good proxy in the absence of any other data. But if anyone else got any other data, please leave me a comment on this video or drop me a message on my LinkedIn. I'd love to see real data. I only like dealing with real data as and where possible. So who houses this difficult remainder of tenants that are being evicted at this point because people are worried about antisocial behaviour or they're worried about other things? A shrinking pool of compassionate or simply naive landlords who are still operating in an old school way? Well, perhaps, but the pool of the difficult remainder is growing and the pool of compassionate landlords and individual landlords is shrinking. Onto the local authority then? Well, they're static or backwards in terms of the amount of stock they've got. This pushes the problem then onto housing providers who are doing the local authority's job ultimately, having to lease units from, guess who? Private sector landlords. So that might shed some light on why I chose the phrase the golden quarter. Because at this point, you'd be well within your rights to say to me, look, Adam, this doesn't sound very golden at all, does it? But let me give you once again the Propenomix perspective. What are our ingredients here as professional investors? Ingredient 1, FUD, fear, uncertainty and doubt. How will all this new legislation play out in anger? Right, there's a metric ton of regulations already that aren't enforced. There's an argument that at least half of the changes in the Renters' Rights Act are spurious and could be covered by correct application of current laws. But FUD is one of the most very powerful ingredients. What about ingredient 2? Well, we have a defined timescale. 1st of May, that's ages away. Well, actually, it's 4 months. And actually, by the time we're all back to work on the 5th of January, it's less than 4 months. And my agent is trying to catch up with all those sale leads from the record number of listings there have been on Boxing Day for sale. They're not prioritising me and my 2 properties that I'm hoping to sell anyway, but they're relying on the agent to manage the eviction, which they almost certainly won't do in a picture perfect or textbook correct way. Now, when there's a defined timescale for anything, the closer we get to that timescale, the greater the opportunities for deals will be. That rule is as old as time, folks. As an aside, I hope Paul Champlina hasn't booked any long holidays before the 1st of May. I suspect he's going to be quite busy. Now, the fact of the matter is, if the Section 21 is served before the 1st of May, it should be okay, we've been told. Who wants to take too many chances around that? Show of hands, please. Anyone fancy being a test case? Crickets, as I suspected, although the less said about cricket, the better at the moment, of course. But you're starting to see the gold in the golden quarter, I hope. What's ingredient 3? A difference of opinion. Now, that's all you need to make a market, you see, and these coming months will be a big one. It's going to take a brave voice, and yet you know that I'm a brave voice, to be advocating for keeping calm and carrying on here. The masses are running for the exit door. As always, their greatest failing is not realising that a terrible time to exit is when everyone else wants to exit at the same time. Ingredient 4, this is a possible, but this government are stupid enough to throw this accelerant onto a fire, the minimum energy efficiency standards. about not being able to legally rent out a property in England that has an EPC at F or below. That's already in place, of course. And all the chat is to move that to C by 2030. It won't have escaped your field of view that by the time you get to the next supplement, the calendar will say 2026. Doesn't leave that long to really draft that legislation, pass it, implement it, change the EPC measurement rules and all the rest of it. And if you're aware of my second channel, Propenomix, I've put a big piece on there today about EPC, minimum energy efficiency standards, the new home energy model, the warm home scheme, and all the rest of it. All confusing, all changing, all happening in a relatively short space of time. All a bit laughable, to be honest with you, but typical governmental action. So, little recap really. Rachel, who was our heroine, perhaps leave off the E on that one. She didn't think much of the Eco4 scheme about upgrading properties for tenants on lower household incomes and things like that, and she scrapped it in the budget. So that only runs till March 2026. I wonder if we'll see warm homes really making up for all of that. There have been concerns, rightly so. I know some of the characters that have been involved in substandard work being done for these eco schemes and it being a big money grab. So the only solution that this government knows ultimately is more regulation, which I suspect will deliver still poor outcomes for double the cost, because the big companies that are involved will still be using the smaller companies that have already been doing the work in order to do the new work. But maybe that's too cynical. But generally speaking, show me the incentive and I'll show you the outcome, as Charlie Munger would have told us, right? So we have heard reports of straightforward fraud in Eco4. I'm not pretending that Eco4 is perfect. £100 million plus worth of fraud. This is just taking the money for works that even haven't actually been done, aside from anything else. Not that hard to do if you know what you're doing in that department, I'm sure. But don't worry, the government will sort it, and dead in the head Ed is our man. It doesn't sound great, does it? And look at his track record so far. Crickets again. Oh well. In line of their cutting of regulation to stimulate growth, there's going to be more regulation and certification and monitoring, and that's going to sort this out, apparently. Will it? That doesn't sound congruent, does it? Oh, well, never mind. 13.2 billion is going in before 2030, and the big cannon of public money will sort it out. So the bad actors will find a way of jumping through the new hoops, and the works will no doubt just be double the price, as I've already said. But Adam, there's no way this can be done, dusted and implemented by 2030. Correct, I'd say. And surely they won't make another seismic announcement on the golden quarter that you've already identified here. Well, don't be so sure, because we know that left hand doesn't talk to right hand, and not a single person in government is remotely concerned with this transitional period between the amateur landlord and the professional landlord that we are 10 years into, arguably, since 2015, and have probably got 20 to 30 years more to play out. But what we're going to see over the next 5 to 10 years is we're going to see this period accelerating apart from anything else. So why don't we have a little bit of indulgence for our last supplement of the year and look at what's happened in recent history. EPCC was going to be done by 2025, mentioned in 2020. That was going to be for new tenancies and existing ones by 2028. That consultation was December 2020. You might remember we're a little bit distracted in our third lockdown of the year at the time. Most people just laughed at it. We had a couple more prime ministers then, and then we had a complete change of administration in the last general election, of course. 2015 was when we saw E set as the legal minimum for 2018 implementation. So at some point, 10 years after that would have looked reasonable. Skipping D, as it's called, I've never understood why we're skipping D, apart from that's something they're not doing in Scotland, because they're far more sensible about this sort of stuff, was just taken as part of the deal. 2020 was the deadline for existing tenancies. 2023, Mr. Sunak scrapped the targets, and the 2025 autumn statement did once again confirm the 2030 deadline within the context of this well-funded Warmer Homes plan. The timeline is in fact April 2028 for all properties to meet EPC for new tenancies. You'll notice that's not much more than 2 years away. So even without a further steer, probably misinformation apart from anything else, or more idiocy, before the end of our golden quarter, there's yet another timeline set that a lot of people don't know about, and some won't listen to it before it actually becomes law. The revised cost cap, 15k, the promise that was set, get those nasty landlords apart from anything else, so very tone deaf unless there's a major league grant scheme on the go, of course, because spending 15k on a property that's worth 50 grand or less up in the northeast compared to a property that's worth £1 million or more down in the southeast, you just can't compare the two. They're completely and utterly different asset classes. They just happen to be a rental property. Now, I reckon 80% of landlords are not on top of this timeline at the moment, at least. Now, the home energy model, the new wonderful EPC that's actually going to see between 15 and 20% of properties already graded C downgraded to a D, aside from anything else, more bad news there on that front. The home energy model's coming in late 2026, which probably means January 2027 at best, doesn't it? So we're going to have complete and utter confusion and scrambling for about 16 to 18 months between HEM being introduced and then the new tenancies for April 2028. It's going to be ridiculous, right? Now, landlords selling up rather than putting in forced money into their properties, survey-wise, the number is 18%. That sounds pretty low to me, aside from anything else, and that's probably because they haven't seen the numbers yet, apart from anything else. But that's the number on surveys, which I'm always sceptical of when talking about people's intentions anyway. But lenders are also in the background grousing at D's and E's in their book, because this is the way it's working for the mortgage lenders and the insurers. The government are nudging them, forcing them, ordering them to have an average of C on their buy-to-let books by the time we get there. So they don't want to lend on D's and E's. What does this mean? Well, it's badged, of course, as a discount for properties that are EPC C or better. And of course, if you're going to average C and you're going to have some D's and E's on your books, you're going to need some A's and B's, and you're going to have to pay to get them. The other way of looking at it is there's a penalty for holding D's and E's apart from anything else. Okay, what about our ingredient number 5 for the golden quarter? Well, the metrics used across the industry are terrible, generally speaking. And that's why Rod and I actually run a dedicated property business workshop on proper metrics aside from anything else. But we're going to need a new one for 2026, Regulatory Risk Adjusted Return, or RRAR. More risk, more returns needed for investors. That's how capital and investment works. Include AWAB's law, EPCC, decent home standards, RRA, more risk, more return. That's what you need. If prices aren't going down, rents are therefore going up. Most letting agents are very lucky. Most investors don't really understand this stuff. REITs are trading at a massive discount, 25 to 30% discount. So if you want institutional grade property, you can buy through a REIT at a significant discount without the huge headaches of management if professionals want residential property exposure. But is it really a golden quarter then? Well, of course it is, Propenomix people. Golden for us, those of us who stay ahead of the game, stay informed, and are capable and capitalise well enough to remember that arguably the very goatist of quotes from the GOAT himself, coming to his final retirement. I salute you, Warren. Be greedy only when others are fearful. Warren E. Buffett. So take the rest of this betwixtmas period to have a full recharge of your cells, hit the ground running in 2026 or sooner if you like. This is a restricted window like no other. And don't even dream of booking any holidays before the 1st of May 2026. And there might even be a few weeks of mopping up after the deadline. There usually is. So as I draw the whole of 2025 to close in the supplement, our next property business workshop is filling up. Early bird ticket sales are still on. We'll start the year with a bang, discussing strategic planning and how to make the most of the next 12 months, with some of our own methods and takes on productivity and time management, alongside systems and processes. The other half of the workshop is about the most common pain point in SME property businesses: accounts, bookkeeping, group accounting. This is about measuring asset performance. It's not how to use Xero, but how to make the most of your financial information. What should you be seeing on a monthly basis? How should you interpret it and use it properly and strategically in order to grow your business quickly but safely? As always, we have real-life case studies about our own experiences, and we close with our no-holds-barred Q&A. If you've got anything individual to consider, get a VIP ticket and join us for dinner in a smaller setting with an opportunity to discuss any specific roadblocks or issues in your property business at the moment. Those dinner tickets are nearly sold out now, but well done to those who've already booked on. Right, there's 4 left as I'm saying this right now. Don't miss out on the VIP dinner tickets. It's the very, very best way to have an individual conversation that's substantial with Rod and myself and the other experienced investors who will be there. So join us on Thursday, the 22nd of January 2026 in central London, tinyurl.com/PBWNINE. Link in the show notes. But please, above all, apart from anything else, remember to keep calm, always listen to the supplement and carry on. You're going to get opportunities next year and towards this 2030 theoretical cliff and beyond. The landscape has been set for a surefire bull run. Capital growth looks set to remain slowish at the moment, although if you're in the right part of the UK, you're going to be well looked after by the combination of capital growth plus inflation. The big bull run needs some money, it needs some runway first, but ultimately let's see what the FCA and the PRA do in the new year around easing lending requirements again. But let's have an amazing golden quarter together. It's a case of here we go, in my opinion. Happy New Year, everybody.